Hey there, let's talk about a smart way to pay less in taxes using something called tax loss harvesting. Think of taxes like a bill you have to pay when you make money from your investments. When you sell stocks or other investments for more than you paid, you owe taxes on the profit. These are called capital gains taxes, and they can take up to 20% of your profit. But here's the cool part. There's a legal way to lower these taxes. It's called tax loss harvesting. Here's how it works. When some of your investments lose money, you can sell them and use those losses to cancel out the profits from your winning investments. This means you'll pay less in taxes. Hi, my name is Tommy Cloud, and I'm president of Third Act Retirement Planning, a company that I started back in 2000. I also have a certified financial planner designation, qualified kingdom advisor designation, and I also studied finance in college, and in fact, got a degree in it. It's important as we talk about tax loss harvesting to, first of all, think about some of the most common and best ways to do it. You can do it by hand and you can do it yourself. We're not going to talk about that. I don't recommend that unless you have very few stocks and you have time to keep up with all this at the end of the year. Another way to do this is through separately managed accounts. You can also do it through direct indexing. We're not going to go into details about those two items. We're going to talk briefly about those. This video is exactly what the title said. It is about tax loss harvesting. So that's what we're going to talk about. There can be other videos. Keep on the lookout for other videos about separately managed accounts, which are called SMAs, and direct indexing. So let me break down something interesting about SMAs and taxes in plain language. And again, we are going to talk briefly about this stuff, just not in detail. SMAs have a special advantage. When you sell investments at a loss, you can use those profits to lower your taxes. You can use these losses to cancel out any investment profits, plus up to $3,000 of your regular income each year. If you have more losses than you can use in 1 year, you can save them for future years. It's pretty neat, right? Let's talk a little bit about how tax loss harvesting works. Think of tax loss harvesting like storing up taxes savings for later. Many people think it gives you two benefits: paying less taxes right now, having more money later because you kept more of your investment. But here's the catch. If tax rates stay the same, you're really just pushing your tax bill to later. It's like getting an interest-free loan from the government. The only times it really helps immediately are if tax rates will be lower in the future, if you're planning to donate your investments. Also, and thirdly, if you can turn short-term gains into long-term gains, which have lower tax rates. Long-term gains have lower tax rates than short-term gains. Now let's go ahead and jump in. Let me show you a couple of graphs that might be helpful in better understanding tax loss harvesting and how it works. Okay, let's get right into this and look at this graph here that I'm showing you. As you can see, this is from 1990 to 2017. It's very simple. And we will have this for you in the comments. You can click on this and download it if you'd like for yourself. But this is some research that Parametric did back in 2018 on tax loss harvesting. All of it still stands true today. But if we go back and look just, for example, the S&P 500, you can see that everything here in red are stocks that went up. Everything here in gray are stocks that went down. So now you can see in a year like 2003, you wouldn't have very much to sell. One key thing to understand about tax loss harvesting is that there's an unlimited amount of gains that you can offset with losses. If you do, let's say, $1 million worth in gains that you realize, you can also offset those $1 million of gains with $1 million in losses if you have them in your portfolio. And we'll get into some of the concerns about that in a minute. But let's say, for example, you look at a year like right here, it was 2007, it's pretty equal. You've got about the same number of losses as you did gains. So you could essentially reset your portfolio that year using the tax loss harvesting there in December and classifying them all under short-term gains. And you do want to do it primarily year by year. We'll talk more about that, and I'll mention it twice. If you go, this is on a 10-year time period. If you hold stocks all in your portfolio for 10 years, it's going to be really hard to do tax loss harvesting because most of the stocks will have gains. So it's really something that I encourage you to do along the way. That's what we do for our clients. We do it along the way, and the people we work with do it along the way as well. But you can see here just the difference, the ending market value for a tax loss harvesting. Really, it's almost $200,000 higher than just a portfolio that just sat in an inexpensive ETF. So that's pretty substantial. And now SMAs do carry a higher fee than ETFs. So even that being considered, this particular research found that before liquidation, the tax loss harvesting was 2.7% better per year, that you had increased your gains. This is all in a taxable account, by the way. This is not in a Roth, and this is not in a traditional IRA or a 401k or a 403b, also, or a simple IRA or a SEP IRA, or any other type of tax-deferred retirement account. Post-liquidation, HSAs as well would be included in that. Post-liquidation, so everybody's paid their taxes now with the ETF. You had the low-cost ETF. You've now paid a management fee for the SMA of 0.35% in this study, and you paid all the taxes, which are going to be more in the separately managed account because you have, as you can see, you have a lower cost basis because along the way, you've been doing tax loss harvesting. Nonetheless, though, it's still about 2% per year that you would have outperformed in a taxable account using an SMA that was doing tax loss harvesting. So this is pretty substantial. Now we're going to look at Vanguard and direct indexing and kind of use their calculator. And I'll show you different information on this coming from a different angle that Vanguard has as well that may help you better understand this. Okay, so let's look at the tax calculator here with Vanguard. And Vanguard, again, does direct indexing. That's not what this video is about. We're still going to try to stay focused here on tax loss harvesting if we can. $1 million invested in the state of Delaware. The annual capital gains is going to be 2.5% of the initial investment. We'll go ahead and calculate it. And you can see this is a graph of the cumulative losses harvested over 10 years. You can see right here that 284,000 is the worst or the lowest amount of harvesting the person was able to do using Vanguard's direct indexing. And again, over here, it's 855,000, which was the most. So that's quite a bit of harvesting that went on, the losses that were realized during that time. And we scroll down, you can see they've annualized it, and the average is probably up here at about 0.5% a year, which of course would be quite substantial, even more than what Parametric found. Vanguard's saying so that's going to average out to 5%. Now, if you go down here, though, of course, you can see that it's only 0.06% a year. So over 10 years, that's going to be about 0.6%, lowest amount of tax loss harvesting as a percentage. Then the most is going to be way up here at 0.63%. But again, if you look, the average is probably here. We could call it 0.4 if you wanted between the two, in between both full liquidation and no liquidation. And again, Vanguard offers direct indexing to our clients and to people out there. And you can also get the separately managed accounts as well. But we'll go into that in later videos. I want to keep moving forward here with the topic of tax loss harvesting. So let's get out of this screen share and move back into that topic. Okay, so let's now talk about the hidden costs that are involved in tax loss harvesting. Obviously, nobody's perfect except for the Lord. And so let's talk about that. So while many investment platforms offer free trading, there are still hidden costs that you need to know about. For example, to save $1 in taxes through tax loss harvesting, you might need to make $200 worth of trades. That's why you should only make these moves when the tax savings will be significantly bigger than the trading cost. I want to pause now for station identification. Again, I'm Tommy Cloud, and if you're enjoying these videos, go ahead and subscribe. I'm putting a lot of time and effort into these, and I do ask that you subscribe to them, which I think is a very small ask for the time and effort that I put into these videos for you to learn more about finance. Also, if you want your portfolio looked at and how tax loss harvesting may benefit your portfolio, click on the link below, set up a time to talk to me. There's no cost. There's no obligation. Also, if you have a portfolio, I can't recall ever a time that I've had someone look at someone's portfolio and it was perfect and it had nothing that could be improved whatsoever. So that's another thing that me and my team will do for you as a complimentary. If you'd like me to look over your portfolio, do that as an audit, or just set up a time to learn and we can talk about your goals and what you're thinking of moving forward. All right, now back to our program, as they like to say. So one of the things about tax loss harvesting is that you want to keep the investment quality high. The most important thing is making sure you don't hurt your investment quality just to save on taxes. You should carefully choose replacement investments that match or improve your investment strategy while following all the tax rules. Think of it like a chess game. Every move needs to consider both the immediate benefit, tax savings, and the long-term strategy, investment growth. Chess is something that I play about 2,000 games a year, and one of the things that you also want to look at in chess is what your opponent is trying to do. Now, how can you apply that to these tax loss harvesting? You don't really have an opponent in there, unless, of course, not paying the government taxes as your opponent. We use special technology. I say we do, people that we work with. We have DFA has separately managed accounts that we utilize for some of our clients, and they have special technology and they look at all these factors. You can do it yourself as well with your financial advisor, or find some other separately managed account. And they look at these factors every day and help to make the best decisions for your money. Remember, smart tax management isn't just about saving money today. It's about growing your wealth effectively for the future while being tax efficient. Okay, now let's talk about another tricky situation, and that's wash sales. Think of it like this. When you sell something for less than what you paid, taking a loss, you can usually use that loss to lower your taxes. But there's a catch. If you buy the same thing within 30 days before or after selling it, the government says, nice try, and they won't let you use that loss on your taxes. This is called a wash sale. You can't come into December and in November buy 1,000 shares of Apple stock, for example, or whatever stock you want to use that's down for the year, and then 20 days later go ahead and sell Apple to harvest those losses while you just bought shares of it 20 days earlier to make sure your position doesn't go down. At the same token, you can't sell on December 6th and then rebuy the exact stock, in this case Apple, on December 27th. It's just not going to happen. And here's the interesting part. This rule doesn't just apply to one investment account. It applies to all your accounts. So if you're married and file taxes together, it includes your spouse's accounts as well. Okay, so let's talk about understanding the long-term tax strategy of tax loss harvesting. Think of tax loss harvesting like finding good deals at a store. It works best when you first start shopping. When you first buy stocks, some will go up and some will go down. We're talking about you buying them together. This is like when we start a direct index fund like at Vanguard, or if we do a separately managed account like at DFA. Those that go down give you chances to save on taxes. But after about 10 years, most of your stocks will probably be worth more than what you paid. So you'll have fewer chances to use tax loss harvesting. It's not something that you can just do every 10 years because everything is going to be a gain. Not everything, but most everything. And that's why we need more than one way to manage taxes. It's like having multiple tools in your toolbox instead of just one. You want to look at several things every day when deciding what to buy and sell. How much profit you expect to make, number one. Number two, how to spread out risk. Number three, the trading cost. And number four, potential tax bills. For people who really want to minimize taxes, you can take it even further by trying to balance out short-term gains and losses for stocks owned less than a year and long-term gains and losses for stocks owned more than a year. Another thing is using smart technology, which we all have the ability to do. You can find companies that use special computer programs to look at every single share of stock you own. When you need to sell something, it will pick the exact shares that will save you the most money on taxes. Again, Vanguard, DFA do this. There's all types of separately managed accounts out there that do an excellent job of this with long-term track records. They can offer you wonderful tax benefits and the privilege to be able to invest your money in a taxable account without having to pay taxes when you withdraw it. It really is a beautiful thing. And it makes almost these taxable accounts as powerful, or maybe even more powerful than an IRA. Of course, you don't get deducted from your taxes, but at the same time, it can grow with very low taxes. And then when you withdraw it, it's not going to be counting as income. So think of it like having a smart shopper assistant, this computer I'm talking about now. I'm going back to that. Exactly which coupons to use, when to use them, except instead of saving money on groceries, we're saving money on taxes. This careful attention to detail helps keep your tax bill not just this year, but for many years to come. The best part, you don't need to be a math genius to do this. You can work with a financial advisor or use a special computer program to help you figure out which investments to sell. Remember, paying less taxes means keeping more money in your pocket. That's money you can use to invest more or save more for the future. Want to learn more about making your money work harder for you? Leave a comment below. Check the like button on the video. Check out my next video about boosting your investment returns, or book a call with me, a no obligation call